Okay, let's unpack this. We were diving into uh, really the bedrock of modern algorithmic trading concepts.
Yeah, the foundations.
Exactly. Specifically, the foundational structure of smart money concepts, or SMC, and also the inner circle trader way of thinking.
Hmm.
If you spent any time at all looking at price action, you know that reading the market correctly is, well, it's everything.
Right, absolutely everything.
And that journey really starts with what seem like two deceptively simple concepts, the swing high and the swing low.
Simple on the surface, maybe.
Right. These 2 points are the absolute building blocks for, well, all the structure mapping that comes after.
And what's fascinating here is how universal this idea is, yet how often traders kind of rush past it. They're looking for complexity.
Yeah, the fancy indicators, the secret sauce.
Exactly. When the foundation is actually the hardest part to truly master, market structure is, it's genuinely the backbone of the market. Lots of the sources we looked at call it that.
The backbone, I like that.
And without correctly identifying these specific structural points, these swing points, you are essentially flying blind. You really are.
So you end up with what, just random trades?
Pretty much. You're left with low probability setups because you just don't know the market's current directional flow. It's like the essential difference between knowing precisely which way the river is flowing and, well, just hoping you don't step into a powerful current downstream.
The sources we analyzed were pretty unanimous on this. Trading without this foundation, it's going to be very, very hard. That's a direct quote.
It really is. It's setting yourself up for failure, essentially.
So our mission today is to move beyond just, the textbook definitions. We're using our curated research to define what makes a swing high or swing low actually count.
The significant ones, yeah.
Right. How they chain together to create bias, on different time frames. And maybe most importantly, understand how these points are used practically, like how institutional money uses them.
To trap retail, essentially.
Yeah, and to define those high probability entry zones. It's the essential shortcut, we think, to truly being well-informed on structure mechanics.
So if we connect this back to the bigger picture, market structure, when you really boil it down, it's just a narrative, right? A story told through highs and lows.
Well, that's okay.
The entire structure of the chart is built upon this dynamic, but the challenge isn't just identifying a high or a low. I mean, the chart's littered with them.
Everywhere you look.
Exactly. It's identifying the ones that actually count for, let's say, institutional purposes. The consensus across the material we reviewed is that these are the external levels.
External level.
Or the major highs and lows. These are the ones that define the true range of price action on a given time frame.
And why do we need that institutional filter? I mean, why not just look at every little peak and valley?
Well, because retail traders often do see every wick as a potential reversal point, right?
Guilty as charged? Sometimes.
We've all been there. But if you try to trade every minor high and low, you'll just get chopped up by volatility. It's death by 1,000 cuts.
Okay.
So we need fixed, undeniable reference points to understand the true boundaries of the current market move. These defined swing points are the essential markers. They delineate the primary structure you're operating within.
And that applies whether it's like the microstructure on a 5-minute chart or the big picture macro structure on the daily.
Absolutely. The principle is the same, just scaled. The fractal nature of the market.
Right, the fractals.
And this is where the methodology, the ACTS-MC approach, provides a really objective mechanical pattern. It simplifies the identification process immensely.
Okay, so not just guesswork.
No, not guesswork. We rely on what's widely known as the 3-candle rule. A swing high or a swing low is identified by a very specific 3-candle pattern that forms that market high or low.
3 candles.
Yeah.
Got it.
And this rule exists specifically to, help identify high probability turning points and filter out all that noise, the sort of momentary volatility that doesn't really mean anything structurally.
Okay, let's nail down that specific geometry then, because clarity here is, well, it's everything, isn't it? For a swing high, what exactly are we looking for?
Right. For a swing high, you need a specific arrangement. You're looking for a central candle, the middle one that makes the highest point.
The peak.
The peak, exactly. And it absolutely must be immediately flanked, so one candle on its left and one candle on its right.
Okay.
Now here's the critical detail. Both of those flanking candles, the ones on the left and right, must have a lower high than that central highest candle. The wicks matter here.
Lower highs on both sides.
Okay.
So the middle one sticks up higher than its immediate neighbors.
That's it. That highest candle is the pivot point. And conversely, for a swing low, you need the opposite. You look for the central candle that makes the absolute lowest point of that little cluster.
The lowest low.
Yep. immediately flanked again by candles on the left and right, both of which must have a higher low than the middle candle. Again, checking the wicks.
Higher lows on the neighbors, so the middle one dips lower.
Precisely. This clean three-candle pattern, especially when it's, confirmed by the price action that follows it, serves to identify the market's legitimate turning points. These are the points we use for tracing the overall structure and trend.
Okay, that sounds straightforward enough. But, if it's so simple, why do some sources mention a five-candle rule? And honestly, why do so many traders still seem to misidentify the structure, even with the three-candle rule? What's the most common mistake people make when they try to apply this?
That's a really crucial distinction. Good question. The five-candle rule. Yeah, you do see that mentioned. It's often used by traders looking for maybe a slightly more established swing, perhaps a longer-term one. But the three-candle pattern, that's the foundational concept. It's for identifying the immediate reversal point, the one that kicks off a new structural leg.
So three-candle is the immediate turn, five-candle is maybe more confirmed.
Sort of, yeah. But the three candle is the core building block. Now, the most common mistake, it's usually failing to enforce the rule strictly, like really strictly.
Oh, so.
Traders often look at the close price of the flanking candles instead of the actual highs or lows, the wicks of those flanking candles.
Okay, so they ignore the wicks.
Exactly. The rule is based on the wicks and the resulting high or low point of the candle itself, not where it closed. So if the left or right flanking candle's wick high is equal to or even higher than the middle candle's wick high, well then it's not a valid three-candle swing high, period.
Gotcha. Strict adherence to the wick highs and lows. So the three-candle rule, then, it's like the institutional filter. It separates the obvious random noise from the genuine turning point that the big money actually pays attention to.
That's a great way to put it, an institutional filter.
And this is vital because these swing points, once you've identified them correctly, they aren't just historical markers on the chart, are they? They have future significance.
Absolutely not just history. Once identified, these structural points become incredibly critical for future price analysis. The analysis across the sources points strongly to the idea that these swings often act as like magnetic level.
Magnets.
Yeah, potential resistance or support zones where institutions will likely re-engage with the market later on. The structural points you identify today become key areas of interest for potential entries or even targets weeks, maybe months down the line.
Wow. Yeah.
We really must view them as potential liquidity targets. We'll definitely get more into that later because the market fundamentally operates between these significant external levels, these major swing highs and lows.
Okay, so once you can consistently pick out those critical swing highs and swing lows using that strict three-candle filter, the next logical step is mapping them together, right?
Right.
To actually define the trend.
Exactly. This is where those static points, those individual dots on the chart, become a dynamic narrative. It shows us whether the market is generally accumulating, meaning going up, or distributing, heading down. Correct. The progression, the sequence of these confirmed swing points dictates the overall market direction. We're looking for continuous patterns here.
Like what?
Well, for an uptrend, a healthy uptrend requires the consistent formation of higher swing highs HH and higher swing lows HL.
Higher highs and higher lows.
Yeah.
Classic uptrend definition.
It is, and this signifies healthy upward momentum where buyers are remaining dominant. Even on the pullbacks, they step in at higher prices each time.
Okay. And conversely, if we see the chart continually printing a lower swing high followed by a lower swing low, so LH and LL, then we know the overall directional bias is bearish, right? Downward.
Precisely. Lower highs and lower lows signal a downtrend. It sounds like, basic geometry, really basic stuff.
It does.
But the nuance, as you mentioned earlier, is absolutely critical. We can't just draw a line across any old wick we see and declare, aha, new swing point confirmed.
Right. Too easy to get faked out.
Exactly. The market needs to prove that a swing is valid, not just offer a fleeting moment of, volatility or a quick spike.
So how does it prove it? What's the confirmation mechanism?
That confirmation mechanism is essential for minimizing those false readings, those fake outs. The market must demonstrate commitment, follow through.
Okay. Example.
Okay, so for instance, a higher high, HH, is only truly confirmed after a valid pullback has occurred. And critically, that pullback respects the previous structure, meaning it doesn't break the prior higher low.
All right.
And the consensus suggests that a higher swing low, HL, is only confirmed after a valid breakout of structure, a BOS, which we'll talk about next, happens after the HL is formed. The confirmation is really in the reaction of the market to that new potential swing point.
Okay, let's flip that. Let's focus on the bearish scenario for a second.
Yeah.
If we're in what looks like a confirmed downtrend, how do we confirm a new lower high, LH?
Good question. In a downtrend, a lower high is confirmed only after the price initiates the next impulse leg down and actually breaks below the previous swing low.
So it has to break the low first.
Yes, that break of the low is the break of structure, BOS, in a downtrend. That confirms the LH that preceded it. Similarly, a lower low, LL, is only confirmed after the subsequent pullback, the retracement upwards, respects the newly formed lower high, and crucially, fails to move higher than it.
What if it does move higher? What if the pullback goes above that last lower high?
Ah, well, if that pullback moves above the previous lower high, then the bearish bias is potentially shifting. That could be an early warning, maybe even a change of character.
Okay, potential reversal signal.
Exactly. So this whole system of confirmation, checking for the BOS, and respecting prior structure ensures we only really commit to the directional bias once the market has demonstrated clear follow-through and respected the key levels.
And that confirmation process ties directly into establishing directional bias, doesn't it? Which I think is probably the most vital concept for like short-term trading, day trading especially.
Oh, absolutely.
We often talk about daily bias, right? Which is basically the current direction you expect the daily candle to ultimately close in.
Yep. Bullish or bearish for the day.
And these swing highs and lows we've been defining, they are the primary tool, the main way we establish this high time frame directional perspective.
100%. If you miss the daily bias, if you just ignore whether the market is fundamentally aiming for a higher high or a lower low on that big macro time frame, you will consistently find yourself trading the wrong side of the market. It's almost guaranteed.
Ouch.
Knowing that macro directional bias informs absolutely everything, even your lower time frame entries. If the weekly and the daily charts are clearly showing bullish breaks of structure and they're targeting some major swing highway up above,
Then you should be looking for buys, right?
generally, yes. You should primarily be looking for buy setups on the lower time frames, like the 1 hour or 15-minute. Trying to sell short against that powerful macro flow, even if you think it's just for a pullback, is incredibly low probability trading. You're swimming against a very strong tide.
Okay, this brings up a really crucial concept then. Higher time frame alignment, or HTF alignment.
Yeah.
What happens when, say, the 4-hour chart gives you this beautiful bullish BOS? Looks like it's going to continue higher, but the daily chart is actually still pointing down, still bearish towards some major liquidity low.
Ah, yes, the classic time frame conflict. That's the kind of scenario that really separates novices from experienced traders who understand structure properly.
So what's the rule? What takes precedence?
The consensus across all the reputable material is clear. The higher time frame always dictates the overall direction. Always.
Okay, daily trumps 4-hour.
Yeah.
Weekly trumps daily.
Exactly. So in your example, if the daily chart is bearish, any bullish move you see on the 4-hour or the 1-hour chart should generally be treated as just a retracement, a pullback.
A retracement to where?
To an optimal sell area, what we call the premium zone, within that larger daily bearish range.
So you can trade the 4-hour bullish move.
You can, technically, but you absolutely must know that its ultimate target is likely temporary. You have to understand that the dominant, overarching directional bias remains bearish until that key daily swing low, or maybe a high, is decisively broken.
So you're trading counter trend on the lower time frame, essentially.
Correct. Which is risky.
Yeah.
The swing points help us map this operative range on every single time frame, making sure we are always trading in the context of the bigger picture. That's key.
Okay, so now let's introduce movement into this. We're moving from just statically identifying the swings to looking at dynamic market action. How do we know the trend we've identified is actually healthy and likely to continue?
That's the million-dollar question, right?
Well, the answer in this framework is the break of structure, or BOS. A confirmed BOS is what confirms the continuation of the current trend. It validates the previous swing, high or low, that held during the pullback.
So BOS means go. The trend is still on. Essentially, yes. It's the definitive sign that the prior swing point, the one that was supposed to hold the pullback, like a higher low in an uptrend, has indeed been respected. The market is now moving on, intending to create a new high or a new low in alignment with that existing trend.
Okay, so in a bullish trend, price needs to break and close above the previous swing high.
Correct, with conviction. And in a bearish trend, it must break and close below the previous swing low. That location of the close is often considered vital for confirmation, not just a wick through.
Right, the close matters. But what separates a really strong, reliable BOS from maybe a weak one that might be deceptive and reverse quickly?
Ah, good point. The consensus across the sources points very strongly to one key factor: displacement.
Displacement, okay, define that.
The sources emphasize that this breakthrough, this BOS, must ideally be characterized by a very big, energetic push-through structure. Think momentum, think power.
So not just barely creeping over the line.
Exactly. Displacement isn't just about one strong candle, though that helps.
Yeah.
It's the market showing a sudden, undeniable imbalance between buyers and sellers. It signals that the market maker intent is now firmly fixed on collecting liquidity, resting at the next major swing point in that direction.
How can you quantify displacement? Or is it more subjective? Is it just seeing a big green candle or a big red candle, or are there more specific things we should look for to judge its significance?
You can quantify it to some extent. Often you're looking for an engulfing move, maybe a single large-bodied candle that completely dwarfs the previous candles, or perhaps a rapid succession of several large candles.
Okay.
They should close significantly outside the previous range or structure point. And crucially, these moves often leave behind large wicks in the opposite direction, or, very importantly, an inefficiency known as a fair value gap, or FVG.
FVG. We'll need to cover that properly later, but it's like a gap in price delivery.
Exactly, a sign of imbalance. That violent move, that displacement, signals true strength and intention. A small, choppy break of structure, maybe with lots of overlapping candles. That's often seen as weak and much more prone to reversal.
So strong displacement equals probable continuation. It leaves the footprints of institutional money behind.
That's a great way to think about it. Footprints in the sand.
So displacement is the market showing its hand, its intent, through high velocity, high momentum. But what if the market fails to continue? What if it pushes up towards a high, maybe even pokes through slightly, but then slams back down? What if the trend definitively seems to be stopping or reversing?
Okay, that's when we start looking for a specific reversal signal. In this methodology, it's known as the change of character, or HCH.
QCH, or sometimes CHCS, change of character structure.
Yes, you see both abbreviations used. CHCH is probably more common. This signal indicates a fundamental shift in market sentiment. It's the initial, often the very first, sign of a potential trend reversal.
Okay, so how does that actually look on the chart? Specifically using those swing points we've been so careful about defining.
Right. It occurs when the market fails to make a new high in an uptrend or a new low in a downtrend that would align with the current trend. Instead, it breaks the key swing point that was supposed to hold that trend together.
Give me the uptrend example.
Okay, uptrend. You're creating higher highs, HHs, and higher lows, HLs. Nice clean structure. The change of character happens when the price fails to create a new HH after the last HL, and instead it turns around and breaks below the most recent higher lows, HL.
It breaks the last HL.
Exactly. That higher low was the protective structure for the bullish trend. Breaking it decisively signals that the buyers who were stepping in there have lost control, and sellers are now stepping in with enough force to shift the character of the market from bullish to potentially bearish.
So it's kind of the institutional equivalent to what traditional technical analysts might just call a trend reversal.
Pretty much. But the key difference is that CHCH provides a much more objective, often earlier trigger point based on that specific structural break, rather than waiting for lagging indicators like moving average crossovers or something.
Okay, objective trigger. But here's where the nuance probably comes in again, right? How do we validate this CHCH? Is every single break of the previous higher low a guaranteed reversal? Because that sounds too easy.
You're right. Absolutely not guaranteed. And the sources are very clear on warning about this. Volatility, news events, they can cause small temporary breaks that are very quickly reversed.
The fake outs again. Or a liquidity grab below the low.
Precisely. A liquidity grab. So we need some form of validation. The consensus seems to suggest measuring the latest impulsive movement, the one that actually caused the CHCH, and comparing its size or strength to the previous impulse that was with the trend.
Comparing the reversal move to the prior trend move.
Yes. Specifically, one common guideline is that the reversal impulse, the move that broke the structure and caused the CHGH, should ideally be at least half the size, or maybe show similar displacement characteristics as the previous impulse that continued the trend.
At least half the size. Why exactly half? Is there specific sourced rationale for that number, or is it more of a common discretionary guideline that mentors use to filter out the small, choppy moves?
Yeah.
It sounds a bit arbitrary.
That's a fair challenge. It is generally more of a guideline, yeah.
Yeah.
Derived from, empirical observation across the trading community. It's an attempt to filter out what's perceived as minor noise or just a temporary stop run.
Okay, so the logic is,
The rationale behind it is essentially this. If institutional money is truly stepping in with force to reverse the established trend, then their initial impulse, the move causing the CHCH, needs to demonstrate significant strength. It needs to be powerful enough, say, at least 50% of the prior move's momentum, to prove they've actually overcome the inertia of that preceding trend.
so if the breaking move is weak, small, choppy.
Right. If it's weak, it might suggest that the buyers or sellers who triggered that CHCH simply lacked the volume or the real conviction needed to sustain that new direction. So the 50% idea, or just looking for strong displacement on the CHCH move, acts as a filter for genuine conviction versus just a temporary blip.
That attention to sort of quantitative detail, or at least comparative strength, is probably why these concepts can be so effective when applied right.
Okay.
We have objective rules, more or less, for confirming continuation, that's BOS, with displacement, and then for signaling a potential reversal, that's COCH, ideally with validation based on its strength.
Exactly. It provides a structured way to interpret price action dynamics.
Okay, here's where it gets, for me anyway, really interesting. This is where we connect those kind of abstract structural lines on the chart to the actual kinetic movement of massive amounts of institutional money.
Yeah, the why behind the moves.
Exactly. The sources we looked at are absolutely crystal clear on this. Liquidity is the fuel. Without liquidity, which just means orders ready to be filled, nothing moves efficiently in these markets. Liquidity is, and this was emphasized, the single most important concept in ICT.
It really is the lifeblood of the market, and for smart money traders, understanding liquidity is all about knowing where the stop losses and the pending entry orders are sitting.
Okay, and where do retail traders consistently place those stop losses and pending orders? We kind of hinted at it earlier.
You guessed it. Almost invariably, just above obvious swing highs or just below obvious swing lows. These are the points of maximum predictable pain for the average retail trader.
Because they're looking for easy reference points, right? When a retail trader goes short at what they see as a resistance level, a swing high, where do they put their stop? Just above it.
Yep, just above the high. Protect the position.
And when they go long at what looks like support, a swing low, the stop goes just below that low. It's almost automatic behavior.
It's incredibly predictable behavior, and that's the key, precisely. So we categorize these clusters of orders, liquidity sitting just above a swing high, or maybe a series of relatively equal highs. That's called buy-side liquidity.
Buy-side liquidity. Okay.
Yeah.
What orders make that up?
That pool consists mainly of two things. Buyback stop orders from short sellers who are being forced out of their positions as price moves against them, and pending buy stop entry orders from breakout traders who are hoping for price to continue higher.
Okay. And below the lows.
Conversely, sell-side liquidity sits below swing lows or equal lows. That's composed of sell stop losses from long positions getting stopped out, and also new pending sell stop orders from traders anticipating a breakdown lower. These zones are just massive, clearly defined pools of resting orders, pools of money ready to be absorbed by the large players who need them.
And this feeds directly into the whole smart money strategy, which, let's be honest, is essentially institutional manipulation, isn't it?
You could definitely call it that. Institutions, the big players, they simply cannot fill their massive order sizes efficiently in areas where there isn't much opposing volume, in low liquidity areas.
They need someone to take the other side?
They need enormous counterparty volume, so they achieve this by strategically and often very deliberately pushing price past these obvious swing levels, these highs and lows, where they know retail stops are clustered.
Why?
To trigger those clusters of stop losses, this sudden influx of orders allows them to fill their own large positions at significantly better average prices than they could otherwise. It's a pure exploitation of predictable retail behavior patterns.
It's often referred to as shaking a tree to make the fruit fall. I saw that analogy used.
That's a perfect analogy. Think about it. Imagine an institution wants to sell a massive position, maybe unload millions of shares or contracts. The price is currently trading just below a clear resistance level, an obvious swing high.
Okay.
They need buyers to take the other side of their huge sell order. So what do? They nudge the price just above that swing high.
triggering the stops.
Exactly. Triggering all the buy stop losses from the track short sellers, and also triggering the eager breakout buy orders. As all those buy orders suddenly flood the market,
The institution gets filled.
the institution happily fills its massive sell order at that higher, more profitable price, absorbing all that buy-side liquidity. And then, often, what happens? The price reverses sharply downwards, leaving the breakout buyers trapped.
Wow. Okay, when I first read the sources describing this whole process, I had this light bulb moment. I realized every single time I'd been stopped out right at a major swing high just before a massive drop.
Yeah.
I wasn't just unlucky. I was literally the fuel for an institutional trade. That shift in perspective, it just changes how you view every single chart, doesn't it?
It absolutely should. It teaches you to start looking at those key swing points not just as potential support or resistance, but primarily as targets for liquidity.
Targets.
Now, what's really crucial to understand here is differentiating between what's called a liquidity sweep and a liquidity run. They sound similar, but the implications are different.
Okay, break those down. Sweep versus run.
A liquidity sweep, sometimes called a stop hunt or a grab, means the price hits into a swing point, maybe just pokes through slightly, quickly grabs the liquidity resting there, and then often reverses quite sharply, maybe within just a few candles.
So that's the manipulation phase.
Often, yes. It signals a likely reversal, perhaps back towards the opposite side of the current trading range to target liquidity there.
Okay, so that's a sweep. What's a liquidity run?
A liquidity run implies something different. It implies that the price, after grabbing the liquidity at that swing point, is actually likely to continue pushing right through that point, aiming towards the next major swing, high or low, further away. It's a continuation move fueled by the liquidity grab.
So how do you know which one it's likely to be? Sweep or run?
That comes back to understanding the structure context. Specifically, was that move that grabbed the liquidity characterized by strong displacement, suggesting a BOS and continuation? Or was it met with a swift rejection, maybe forming a reversal pattern right after the grab, suggesting a CH or sweep?
So strong displacement through the liquidity point suggests a run.
Generally, yes. If we grab liquidity at a swing high and immediately see powerful displacement pushing higher, leaving inefficiencies like FEGs, the run is likely to continue towards the next higher target. If it grabs liquidity and immediately reverses hard, that looks more like a sweep.
Okay. Ultimately, then, the consensus seems to suggest the market is always moving towards these key swing points. They act like price magnets.
Exactly. Price magnets is a good term, because without attracting and absorbing liquidity at these clearly defined points, the financial markets simply cannot function efficiently. Every significant structural swing point you identify is potentially a future magnet for price delivery. Okay, let's transition now into the really immediate, actionable application of all this. How do we use these confirmed swing highs and swing lows for actual trade location? Where do we look to enter?
Yeah, the practical part.
This is where we define the concept of value within the current price leg or impulse move. And the answer lies in first defining the range of the specific price impulse you are currently analyzing.
The range. How?
We use the most recently confirmed swing high and the most recently confirmed swing low of that specific move. Those 2 points become the boundaries.
Okay, so the highest high and lowest low of the current move that you're focused on.
The confirmed highest high and lowest low, yes, using our 3-candle rule and structural confirmations. This sounds simple, but getting the range right is absolutely critical. Because that defined range, from the lowest confirmed swing low up to the highest confirmed swing high of that current impulse, that becomes our playground, our area of operation.
Okay, our playground.
And this is where we apply the Fibonacci tool, but not in the traditional way with all the complex levels. In SMC, it's often referred to more simply as the premium discount tool.
Premium discount tool.
We use the high and the low of that impulse range to draw the tool, but we're primarily focusing on just 3 key levels: the 0, which is one end of the range, the other end, and critically the 0.5 or 50% level. That's the midpoint.
The equilibrium.
Exactly, the equilibrium price for that specific range. The Fibonacci tool then divides that range into 2 critically important zones based on that 50% midpoint.
Which are?
Everything above that 50% midpoint is designated as the premium zone.
Premium expensive.
In institutional terms, yes. Relative to that immediate price move, the asset is considered expensive or at a premium price when it's in that top half.
Okay, and below 50%.
And everything below the 50% midpoint is the discount zone, representing cheaper, more favorable prices relative to that move.
Discount cheap, got it.
This simple division gives us the institutional perspective on value within that specific price leg. And the goal is always, always to achieve a superior risk-to-reward ratio on our trades.
And this leads directly to the primary actionable rule of trade location, doesn't it? Derived directly from identifying these swings and drawing the fib.
It does. The fundamental rule is this. Traders should always aim to buy in the discount zone, below 50%, and sell in the premium zone, above 50%.
Always buy low, sell high within the context of that specific range.
Precisely. Why is this so critical? Because entering a trade outside of that optimal zone, say buying way up in the premium or selling down in the discount, it severely compromises your potential risk-to-reward ratio right from the start.
How so?
Well, think about it. If you try to sell when the price is already retraced deep into the discount zone, way below 50%, you're essentially selling too low. There's insufficient room left for the price to move down further in your favor before it potentially hits previous structural lows or finds support. Your potential profit is limited, while your stop loss might need to be quite wide.
Bad RR. Risk reward.
Exactly. Bad RR. So the discipline is, we wait. We wait for the price to retrace back into the optimal zone for our intended trade direction.
But when it gets there, into premium for a sell or discount for a buy, we don't just blindly hit the button, right? We need more confirmation, maybe confluence with other things.
Absolutely right. We don't just jump in randomly within the zone. We need a confirmation at specific points of interest within that optimal zone. And this is where other key SMC concepts like order blocks, OBs, and fair value gaps, FVGs, come into play. They act as precise institutional levels within the broader premium or discount zone.
Okay, so premium discount gives us the general area. OBs and FVGs give us the potential pinpoint entry level.
That's a very good way to summarize it. And we absolutely must link these back to the dynamics we discussed earlier, like displacement and BOS.
How do they connect?
Well, order blocks and fair value gaps are often created during that strong displacement phase, during the break of structure move. An order block is typically seen as a cluster of institutional orders, often represented visually by the last down candle just before a sharp bullish move, or the last up candle just before a sharp bearish move.
The candle that started the big push.
Essentially, yes. And a fair value gap, FVG, as we touched on, is that price vacuum, that inefficiency or imbalance in price delivery left behind by that violent displacing institutional push. Institutions often look to revisit these areas to mitigate positions or re-enter.
Okay, so let me try and put the whole process together then. Right. Step 1, identify the current valid range using the confirmed swing high and swing low based on the 3-candle rule.
Correct. Define your playground.
Step 2, establish the directional bias. Are we generally looking for a BOS continuation in line with the higher time frame trend, or maybe anticipating a CHCH reversal?
Yes. Know which way you expect price to go next.
Step 3, patiently wait for price to retrace into the optimal zone premium for sells, discount for buys based on the 50% fib level of that range.
Crucial patient step, yes.
Step 4, look for a high probability point of interest, like a clear order block or an obvious fair value gap, located within that optimal premium or discount zone for a precise entry confirmation.
That is the complete high-level framework. That's the ideal sequence.
Can you give a concrete example, like a sell setup?
Sure. Let's say the market has recently displaced strongly through a previous swing low. That's a bearish BOS, indicating strong selling pressure.
Okay, bias is down.
Bias is down. So you know you should be looking for a short entry opportunity. You then wait for price to pull back to retrace upwards. Where do you want it to retrace to?
Into the premium zone?
Yeah.
Above the 50% level of the range that just broke the low?
Exactly. You want to sell high. As price enters that premium zone, you scan for key institutional reference points, maybe an unmitigated order block that was formed during the down move, or a significant FVG. When price tests that specific level within the premium zone and shows signs of rejection, that's your high probability short entry trigger.
And selling high in the premium zone ensures a more favorable risk reward.
Precisely. Because you are selling at the best available price point relative to that recent structural move downwards. Your stop can potentially be tighter, just above the structure or OB, and your target could be the next major low, offering a good potential RR. This whole practice ensures your entry is always aiming for a high value and high probability within the established structural context.
Which really makes that initial accurate identification of those swing highs and swing lows absolutely foundational, doesn't it? Because if you misidentify the initial range,
everything else falls apart.
Your Fibonacci lines will be drawn incorrectly, your premium and discount zones will be completely wrong, and that will lead you to potentially enter a trade at a really low probability location, maybe even buying in premium or selling in discount without realizing it.
Exactly. Garbage in, garbage out. Structure is everything. Hashtag tag outro. So we started this deep dive with really the core mechanics of market structure, the seemingly humble swing high and swing low.
Yeah, the building blocks.
By enforcing that strict three-candle rule, we established how to identify the legitimate boundaries of market action, filtering out the noise.
Right.
We then demonstrated how those boundaries, those swing points, transform into the essential framework for identifying the trend via break of structure, BOS, and change of character, CHIT.
Continuation versus reversal signals.
Exactly. Then we saw how these same swing points serve as critical institutional manipulation targets, magnets for liquidity.
Where the stops get hunted.
Where the stops get hunted, yeah. And finally, how they ultimately define our optimal trade locations using the practical application of premium and discount zones derived from the Fibonacci tool.
It all ties together beautifully when you see it laid out like that. You now have the fundamental definitions of structure required for really all subsequent SMC or ICT learning.
It's the prerequisite.
It really is. And those sources we looked at really stress that simplifying these core concepts, focusing only on the essential confirmed few swing points, is absolutely key. There was a consensus across the material suggesting something like, 80% of what you might learn in overly complicated trading courses is probably unnecessary noise, stuff you'll never actually use.
Yeah, analysis paralysis.
All right, master the structure first, get that foundation solid, and the rest of the concepts, order blocks, FEGs, liquidity types, they all become much easier to understand because they have context.
Well said. And, this raises an important question, maybe something for you to consider as you go back and look at your own charts with this framework in mind.
Okay, hit us with it.
We learned that the market fundamentally needs to move to fill inefficiencies, like FEGs, and to collect liquidity resting at those key swing points.
Right. Liquidity and efficiency are the drivers.
So here's a thought. If you observe price violently breaking a key swing high or low, doing so with that strong displacement we talked about. But that strong move doesn't immediately continue and target the next obvious pool of liquidity, maybe a major high or low from the previous week, or a very obvious untested level. What signs might the market be giving you then?
Interesting. So it breaks structure strongly, but then stalls.
Yeah, it stalls or starts pulling back before reaching that next logical liquidity target. What might that tell you about the institutional strength or intention behind that initial breakout move? Is that displacement really strong enough to overcome the inertia and continue the run immediately? Or is the market perhaps pausing intentionally, maybe setting up for a deeper retracement first, perhaps back to fill the inefficiency like an FVG that was left behind during the initial displacement before it continues its mission towards that next major liquidity pool?
So, is the pause a sign of weakness or just a necessary reload before the next push?
That's the question to ponder. The market always moves with purpose. Trying to decipher those intentions based on how price reacts after breaking structure and interacting with liquidity and efficiency is really the key to trading alongside the big players rather than becoming their exit liquidity. Something to think about.